Welcome to Open and Distant Learning Center, LAUTECH. I'll be taking you through ACT 306 Petroleum Accounting. We are looking at Study Section 3, Historical Cost Methods and Financial Reporting in Oil and Gas Operation. An accounting system is used by companies that incurred exploration costs for oil and gas that does not differentiate between operating expenses associated with successful and unsuccessful exploration projects. Regardless of the outcome, successful and unsuccessful operation expenses are capitalized. By contrast, the successful effort accounting method only capitalizes expense relating to successful venture. We have learning outcome for study section 3. On completion of this study section, you should be able to explain the concept of oil and gas accounting methods. You should be able to describe the accounting treatment, ceiling test, certain property cost, and treatment of this cost under the accounting method of oil and gas, which is a successful effort and full cost method. Then you should be able to highlight the differences of depletion, depreciation, and amortization, asset impairment and disposal linkages, preparation of final account using the successful effort and the full cost method. The concept of historical cost method. The concept is based on two methods: successful effort accounting method and full cost accounting method. Now, there are basically two alternative methods for calculating for acquisition, exploration, and development and production cost in oil and gas, exploration and production. Now, we use successful effort method and full cost method as I mentioned earlier. Costs that are known at the time of incurrence to fail to meet this criteria are generally charged to expense in the period they are incurred. Now, we said under this successful effort, only those costs that led directly to the discovery, acquisition, and development of specific oil and gas or crude oil. Now, under the second one, the full cost accounting method, all costs incurred at any time and at any place in a cost center in an attempt to add commercial reserves are essential part of the cost of any reserves added in that cost center. As a result, they are directly associated with the enterprise's reserves in that center, and all the costs should be treated as part of the cost of the mineral assets in the cost center. Accounting treatment in oil and gas. In Statement of Financial Accounting Standard, the FASB, Financial Accounting Standard Board, requires that oil and gas companies use the successful effort method, while the successful effort SEC allow companies to use the full cost method. The SEC as Security Exchange Commission, and these two governing bodies are yet to find the ideological common ground needed to establish a single accounting approach. So the choice of accounting method in effect receive regularly approval because the Financial Accounting Standard Board, which is responsible for establishing and governing GAAP, and the Security and Exchange Commission, which regulates the financial accounting format and content of publicly traded companies, are divided over which is the correct method. Now, the two methods represent conflicting view in the industry about how oil and natural gas companies can almost transparently report their earnings, and the two organizations that regulate accounting and financial reporting. So the Financial Accounting Standard Board and the Securities and Exchange Commission cannot always agree on which method is most appropriate. That's for the treatment of oil and gas accounting. Now, the categories of cost in oil and gas. We have about 4 categories of cost in oil and gas. We have acquisition cost, we have exploration cost, we have development cost, we have production cost. Regardless of the method it chooses to follow, an oil and gas company engage in the exploration, development and production of new oil or natural gas reserves will incur costs that are identified as belonging to one of 4 categories. Now, let's take it one after the other. Acquisition cost. What is acquisition cost? Acquisition costs are incurred in the cost of acquiring the rights to explore the natural resources, develop and produce oil or natural gas. They include expenses relating to their purchase or lease, the right to extract the oil and gas from a property not owned by the company. Also include an acquisition cost are any lease bonuses payment paid to the property owner, along with the legal expenses and title search, brokers and recording costs. Under both SEC and FEC accounting method, acquisition costs are capitalized. Exploration cost. Typical of exploration costs are charges relating to collection and analysis of geophysical and seismic data involved in the initial examination of a targeted area and later used in the decision of whether to drill at that location. Now, other costs include those associated with drilling a well, which are further considered as being intangible or tangible. Now, we have development cost. These are costs involved the preparation of discovered reserves for production, such as those incurred in the construction or improvement of roads to access the well site, with additional drilling or well completion work, with the installing other needed infrastructure to extract pumps, gather pipelines and store tanks, the oil or gas from the reserve. Now, both SEC and FEC methods allow for the capitalization of all development costs. That is, the both method is allowed. Production cost. Production costs incurred in extracting oil or gas from the reserve is considered production cost. Typical of these costs are wages for workers and electricity for operating well pumps. Production costs are considered part of periodic operating expenses and are charged directly to the income statement under both accounting methods. Now, we have depreciation, we have depletion and amortization. That is what we refer to as DD and A. Now, depreciation is a means of allocating the cost of material, assets over its useful life, such as operating equipment. Now, we have depletion is used to allocate the cost of extracting natural resources from the earth and is the actual physical depletion of a natural resources by a company. Now, amortization. This is the deduction of capital expenses over a specific period of time. Now, it could be the life of an asset, which in the case of oil and gas refer to tangible, not drilling, cost sustained while developing the reserves. Now, if we are looking at accounting treatment for the depreciation, for depletion and amortization, we are using basis for amortization. Now, we are picking it one after the other. Basis for amortization. The most common used method of computing amortization of oil and gas property is unit of production method. That is, in line with the provision of SAS 14 and 17 standard. Now, the unit of production method assigns a pro rata portion of capitalized cost of oil and gas properties to each unit of reserves. Now, the unit of production method, we have the C minus AD minus X multiplied by P over R. Now, we have C to be capital cost of equipment, AD should be accumulated D and DD and A, that is the depreciation, depletion and amortization. We have X should be salvage value, that is the scrap value. Now we have P to be production during the year in barrels, and we have the R to be reserves remaining at the beginning of the year. That is to calculate the unit of amortization method of the production. Now, the formula of amortization. The concept will be expressed as unamortized cost at the end of the period multiplied by production for the period divided by the reserve at the beginning of period. Now, an alternative form of the above formula is production for the period over reserves at the beginning of the period multiplied by unamortized cost at the end of the period. We have an illustration. Kabuga Petroleum Company PLC had the following data at the end of its financial year ended 31st December 2001. You are required to calculate the D, D and A for the year. Now, the information is capitalized cost at the end of the year to be 1.7 million. Accumulated amortization is 100,000, and we have reserves estimate at the beginning of the year to be 5 million per barrels. We have production during the year to be 250,000 per barrels. Now, what we need to do is to calculate for the amortization, and as we have it that the production during the year divided by the reserve estimate at the beginning of the year, then we multiply by the capitalized cost at the end of the year, we minus the accumulated amortization, then we have our amortization value of unit of production to be 80,000 naira. We have come to the end of this study section. Thank you for listening. See you in the next class.